What if the system isn't collapsing, but slowly tightening around you day by day? What if your savings aren't actually growing, even though the numbers look higher on paper? And what if the reason everything feels more expensive isn't just inflation, but something deeper happening underneath the financial system itself? Because right now, people are seeing gold near historic highs, silver moving violently up and down, oil refusing to stay calm, and interest rates that just won't go back to where they used to be. And the natural reaction is to assume something is breaking. But here's where it gets uncomfortable, because when you zoom out, a lot of the pressure people are talking about is real. Debt is higher than it's ever been. The cost of borrowing that debt is rising. Governments are spending more just to keep things stable. And at the same time, everyday life is getting tighter. Groceries, insurance, rent, energy, all moving in the same direction while incomes struggle to keep up. That disconnect between what the system says and what people feel is where confusion starts building. And once confusion builds, narratives start spreading fast. You hear things like, the system is finished, silver is going to 4 digits, the dollar is about to collapse, and all of it sounds extreme, but not completely crazy either. And that's the problem, because when pieces of the story are true, it becomes very easy to believe the entire conclusion without questioning how those pieces actually connect. So before jumping to outcomes, we need to slow this down, because what's happening right now is not simple, it's layered. And if you don't understand the layers, you can end up reacting to noise instead of reality. And the truth is, the system might not be breaking overnight, but something inside it is definitely under pressure. And the real question is not whether that pressure exists, it's how it actually plays out from here.
So naturally, once that pressure starts showing up in multiple places at the same time, people begin connecting the dots, and sometimes connecting them too quickly. You start hearing the same claims repeated over and over, that the financial system is already finished, that gold is warning of a currency collapse, that silver is massively suppressed and about to explode into 4 digits, that war and energy shocks are about to send everything into chaos. And on the surface, it all sounds dramatic, but here's the part that makes it hard to ignore. Some of the underlying signals behind those claims are actually real. Gold has been trading near elevated levels, silver has already made aggressive moves this year before pulling back sharply. Oil has been unstable with geopolitical tension constantly in the background. The Federal Reserve has not fully defeated inflation, and they've admitted uncertainty going forward. So when people say, look, everything is lining up, they're not imagining things out of nowhere. But this is exactly where most people make a critical mistake, because they take multiple real pressures and compress them into one single conclusion, that everything must break all at once, right now. And that leap from pressure to immediate collapse is where the story starts to lose precision. Because systems under stress don't always fail instantly. Sometimes they stretch, sometimes they adapt, and sometimes they keep functioning much longer than people expect, even while the underlying problems continue building. So the real question isn't whether the pressure is real. The pressure is clearly there. The real question is whether all of that pressure actually translates into a sudden collapse, or whether it plays out in a much slower, more complex way that most people aren't prepared for. And once you start looking at it that way, the story becomes a lot less simple and a lot more important to understand correctly. So let's slow this down and look at what's actually happening in the markets right now. Not what people feel, not what headlines suggest, but what the data is really showing. Because gold, yes, has been trading near elevated levels, not quietly, but with clear strength over the past year. And that usually signals something important about long-term confidence in the system. At the same time, silver has been far more unstable. It pushed higher aggressively, then pulled back sharply, And now it's moving in a way that confuses almost everyone watching it. And that confusion matters, because if silver was simply a crisis metal, it should move cleanly in one direction during stress, but it doesn't. Then you layer in oil, still sitting at levels that keep inflation pressure alive, especially with ongoing geopolitical tension that can shift supply expectations overnight. And on top of that, the Federal Reserve hasn't returned to easy money. Rates are still elevated compared to what people got used to for years, and the Fed itself has admitted that inflation is not fully under control. So when you combine all of that, strong gold, unstable silver, elevated oil, and tight monetary policy, you don't get a clean signal. You get a conflicting one. And conflicting signals are exactly what create emotional reactions in markets. Because people expect everything to line up neatly. Crisis equals metals up, dollar down, system breaking, but real markets don't behave that cleanly. In fact, what we're seeing right now is something much more complicated. A system that is under pressure but still functioning. A market that is reacting but not in a straight line. And an environment where short-term moves don't always reflect long-term direction. And once you understand that, you start realizing something important. The situation isn't simple, it's layered. And if you try to read it as a one-direction story, you're going to misunderstand what's actually happening underneath.
Now, here's the part people keep talking about, but very few actually explain properly, the so-called doom loop. Because when people say the system is breaking, what they're usually pointing to is not one single problem, it's a chain reaction. And the easiest way to understand it is this. Debt feeds interest, interest feeds deficits, deficits require more borrowing, and more borrowing increases the total debt even further, and that loop keeps reinforcing itself. Right now, the United States is sitting on over $30 trillion in debt, and the cost of servicing that debt has been rising fast because interest rates are no longer near zero. That means the government is spending more just to maintain existing obligations, not even to improve anything, just to keep the system running. And when those costs rise, the only real options are either to cut spending, raise taxes, or borrow even more. And historically, the system tends to choose more borrowing because it's the least politically painful in the short term. But here's where it gets more serious, because more borrowing increases the supply of government bonds, and when supply increases while demand becomes more sensitive, yields start rising. And when yields rise, borrowing becomes even more expensive, which feeds directly back into the deficit again. That's the loop. And it doesn't explode overnight, it tightens gradually. At first, it just looks like higher interest payments. Then it starts affecting budgets. Then it starts influencing policy decisions. And eventually, it begins to leak into the real economy through higher financing costs, slower growth, and weaker confidence. And this is why people feel like something is off, even if nothing has collapsed yet. Because the system isn't breaking in one moment, it's being pressured from multiple directions at the same time. And once you understand that, you start seeing why markets don't behave cleanly, because they're trying to price a system that is still functioning, but under increasing structural strain.
So now you get to the part that confuses almost everyone. Because if the system is under pressure, if debt is rising, if inflation hasn't fully gone away, if geopolitical risk is increasing, then why doesn't everything move in a straight line? Why does silver drop right when fear is rising? Why does gold pull back at moments it should be rallying? And why does the dollar sometimes get stronger in the middle of all this stress? That contradiction makes people think something is manipulated or broken. But here's where it gets more precise. Markets don't move based on what should happen. They move based on what participants are forced to do in the short term. And in a stressed environment, liquidity becomes more important than logic. If large players are leveraged somewhere else, whether in equities, bonds, or derivatives, they don't sell what they want to sell, they sell what they can sell. And precious metals are liquid. That means they can be used as a source of cash when positions need to be covered quickly. So you can have a situation where the long-term case for gold and silver is getting stronger, but the short-term price is falling because of forced selling. At the same time, the dollar can actually strengthen during stress, not because it's fundamentally perfect, but because the global system is still built around it. When people need immediate liquidity, they still run to the deepest pool, and that's the dollar. That doesn't mean the dollar is healthy long-term. It means it's structurally central right now. And once you understand that distinction between short-term liquidity moves and long-term structural direction, a lot of confusing price actions suddenly make sense, because what looks like contradiction is often just different time frames colliding. And if you don't separate those time frames, you end up reacting emotionally to moves that are actually mechanical.
Now, this is where the conversation around four-digit silver needs to be handled carefully, because the idea itself isn't completely insane, but the way most people talk about it usually is. And to understand that properly, you have to separate gold and silver first, because they don't behave the same way. Gold is the reserve asset. It's what central banks buy when they want stability, credibility, and long-term protection. That's why central banks have been accumulating gold consistently, not because they're speculating, but because they're managing trust in a system where currency credibility matters. Silver is different. Silver lives in two worlds at the same time. It has a monetary history, yes, but it's also an industrial metal used in electronics, solar panels, and manufacturing. And that dual role makes it much more volatile. It can move faster than gold on the upside, but it can also drop harder when liquidity tightens or industrial demand expectations shift. That's why silver often attracts the biggest predictions, because its moves are more explosive, but also the biggest frustration when those moves don't happen in a straight line. Now, could silver go dramatically higher over time? Yes, if you believe that currency confidence weakens, physical demand stays tight, and investment demand continues rising, there is a real case for higher prices. But jumping straight from that to four digits without asking the next question is where people lose discipline. Because if silver is at $1,000, what does that mean about the currency it's priced in? What does that mean about the cost of living, energy, housing, and taxes in that same environment? A higher nominal price doesn't automatically mean increased real wealth, and that distinction matters more than most people realize. Because the real purpose of holding metals isn't to chase a number, it's to preserve purchasing power in a system where the value of money itself may be under pressure. And once you frame it that way, the conversation becomes less about hype and more about positioning.
So when you step back and look at everything together, the debt, the interest costs, the pressure on consumers, the behavior of gold and silver, the instability in energy, the uncertainty in policy, the picture that starts to emerge is not one of sudden collapse, but one of increasing strain. A system that still works but requires more effort, more borrowing, more intervention just to maintain stability. And that's an important distinction, because systems don't usually break when everything is obviously wrong. They break when they look stable on the surface, but are quietly losing flexibility underneath. And right now, that loss of flexibility is showing up in multiple places at once. Growth is slowing, costs are staying elevated, confidence feels weaker than the headlines suggest, and even though nothing has snapped yet, the margin for error is getting smaller. So the real question isn't whether one dramatic event ends everything overnight. The real question is whether we're moving into a period where purchasing power,
confidence and financial stability continue to wear down over time. And if that's the direction, then the focus shifts away from predicting the exact moment of a break and toward understanding how to navigate a system that's becoming more volatile, more sensitive, and less forgiving. So let me leave you with this. What do you think breaks first from here? Confidence, credit, or the real economy? And when silver makes its next major move, do you think it comes from tightening physical demand, weakening currency trust, or both happening at the same time?